So, how does a company that sells literally everything from nuts and bolts to biohazard suits not only survive but actually thrive when the economy hits a rough patch? Well, Grainger's 2025 earnings report just dropped, and it tells a fascinating story of blending that old school industrial might with a surprisingly powerful digital strategy. So, let's dive right in and break it all down. All right, here's what we're going to cover. First up, we'll check their 2025 report card. Then we'll peek under the hood at the two engines driving their growth. After that, we'll talk about the economic storm they had to fly through, how they're betting on tech to navigate it, and finally, what their forecast for 2026 looks like. Okay, first things first, let's look at their 2025 report card. Now, this was a tough year for pretty much everyone, right? So, how did Grainger actually do? You got to understand the big story for 2025 was just this gauntlet of challenges. I mean, think slowing market demand, messy tariff disputes, even a government shutdown. A perfect storm, you'd think, right? And yet, Grainger managed to sail right through it and deliver a surprisingly strong performance. Their total sales for the year, get this, a staggering 17.9 times billion dollars. I mean, to put that into perspective, that's more than the annual GDP of some small countries. This isn't just a big company, it's a genuine economic force. Now, this next number, it's not just simple sales growth. It's something called daily organic constant currency sales growth. Yeah, I know, it's a bit of a mouthful, but basically what it does is it strips out all the noise from currency fluctuations and acquisitions to give us the purest look at their core business health. And that core business, it grew by nearly 5%. And what does this mean for the shareholders? Well, the adjusted earnings per share landed at a really healthy $39.48. This tells you that even with all that economic craziness, the company stayed firmly in the black and delivered real value. So the big question is, how did they pull this off? Well, the answer really lies in their two-pronged approach to the market. Let's take a look at the two engines that are really powering this company's growth. Okay, so you really need to think of Grainger as having two very different engines under one hood. And understanding how each one performs, that's the absolute key to understanding the entire company. All right, on one side, you've got high-touch solutions. This is your classic old-school Grainger, a hands-on, super service-intensive model for their largest, most complex customers. And then on the other side, you've got the new school, Endless Assortment. This is their fast-growing, digital-first online business, including powerhouses like Zorro.com. It's tradition and disruption all under one roof. And wow, this chart right here, it tells you everything you need to know. The traditional high-touch business, yeah, it grew at a solid 2.6%. But the endless assortment segment, look at that. It absolutely exploded with 15.6% growth. I mean, there's just no question where the momentum is. This digital business is the rocket ship for the whole company. But, that growth didn't come easy. Not at all. 2025 threw some serious economic headwinds their way. Let's really unpack the challenges Grainger had to fight through. I mean, they were getting hit from all sides. You had tariffs and inflation driving up costs. At the same time, demand in their core market was soft, and then the government shutdown comes along and hurts their public sector sales. And as if that wasn't enough, they had to deal with this tricky accounting thing called LIFO. So you're probably asking, what the heck is LIFO? Well, it stands for last in, first out. It's an accounting method where you assume the last items you bought are the first ones you sell. The important thing to know is that when prices are rising, like they have been, this can really squeeze your profit margins on paper. It's a bit technical, but it's super important for understanding their numbers this year. Okay, so how do you deal with something like tariffs? Grainger's strategy was pretty simple and direct. They passed most of those costs right on to their customers through price increases. Now, that's a risky move, right? You could tick off your buyers. But for them, it was absolutely essential to protect those profit margins. So we've seen Grainger playing some tough defense against all these economic pressures. But here's the exciting part. They're also playing offense, a lot of offense. And they're doing it by making a massive bet on technology to power their future growth. And hey, don't just take my word for it. The CEO himself, D.G. McPherson, he made it crystal clear. He said, and I'm quoting here, "They're just scratching the surface of what's possible, especially with AI." I mean, that's a huge signal about where this company is headed. And this isn't just fluffy corporate speak, They're using AI in some really tangible ways.
We're talking about optimizing marketing for every single product, giving their sales team smarter insights, even hunting for new customer leads and coaching their managers more effectively. It's all about embedding that intelligence into every single part of the business. But their bet isn't just on the digital stuff, the clicks. It's also on the physical stuff, the bricks and mortars, so to speak. They're pouring cash into their supply chain with huge new distribution centers from Oregon to Japan. And they're investing in people, too, growing their sales force by over 100 new sellers just last year.
All right, so with all these investments, all these strategies in motion, what does the road ahead actually look like? Let's turn to their official forecast for 2026. And the outlook is strong. I mean, really strong across the board. They're projecting sales to climb as high as $19.1 billion. They expect that core daily sales growth to speed up to somewhere between 6.5 and 9%. The bottom line here? They see revenue, margins, earnings, cash flow, everything heading up. So what does all this really tell us? Well, it signals a massive amount of confidence. After getting through the storm of 2025, you can tell management is basically telegraphing that, hey, our strategy is working and we're ready for a really strong 2026. Okay, so let's boil it all down. What are the key takeaways here? Number one, Grainger proved it's incredibly resilient in a tough year. Number two, its digital endless assortment business is an absolute growth powerhouse. Three, they are not just sitting back. They're actively managing these economic pressures. And finally, number four, their future is all about a huge investment in tech and AI. So this all leaves us with one final big question. Grainger is trying to do something really, really difficult. Blend a century of industrial strength with cutting-edge tech. In an economy that just keeps changing, is this hybrid model going to be the key to not just surviving, but actually dominating? Well, that's the billion-dollar question for 2026 and beyond.